What's going on, everyone? Welcome back to the channel. In this video we're going to be talking about my top 5 investment strategies that actually work. I've used all of these strategies myself. They're beginner friendly, they're easy to understand, and you can sort of implement them pretty much straight away. So if you want to learn about them, please stick around to the end of the video, where I'll also be giving some of my general top tips for investing, getting started, and how to eliminate some of the mistakes that I've made personally myself. The reason I've done this video is I posted a video about a month ago on my top 5 ways to increase your income. One of those ways I touched on investing and drawing dividends as a way to generate passive income. I had a lot of people asking questions about that, how to start buying stocks and shares in the UK, in the US, where you buy them, how to do it, what's the best ways to do it, blah 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 blah. So I thought I'd basically start off with doing some of these videos to try and help you guys out. Did have planned teaching my girlfriend how to invest using Trading 212. We started filming the first bit of the video. She tried to sign up to 212 and the demand on it was mad, so she couldn't even sign up. But that video will be coming soon, so please make sure to like and subscribe if you want to be notified when that comes out. Right, let's jump straight into it. So as I've said before, I'm not a professional investor, I'm not a financial advisor, a tax advisor, anything like that. I've got no credentials, no degree in this field, and you really should just take whatever I say with a bit of a pinch of. This video is basically for entertainment purposes. I'd suggest that you do all of your own research as well before you invest in anything, and make sure you completely understand any investment product that anyone tries to offer you before you go forward. So with that out of the way, here is number 1. So number 1 on this list is invest in what you know. So whether you're going to invest in a general sort of fund or you're going to buy individual companies, for example, you've had your entire career working in the engineering industry, you are going to have a general grasp of what companies are doing well, where the whole industry is moving, some of the potential hurdles that the industry might face, the innovations that are coming, who's going to profit from them and do the best in the next sort of 5 to 10 years. And that's potentially an edge that you are going to have of knowledge and experience over the average investor. There's a very good book that I've read which talks a lot about this. It's called One Up on Wall Street by Peter Lynch. So he's actually famous for going through his wife's shopping when she comes home from her weekly shop, looking at what companies are producing goods and looking for the next sort of 10 bagger, he calls it, which is the next emerging company that's going to go 10x in value. He did this multiple times and had numbers of successes on this. I'll leave some information in the description about that and a link to the book as well if you want to check it out. But you really shouldn't underestimate what you already might know, whether it's stuff from your career or daytime job, hobbies, interests. There's always companies, there's always services that you buy that you might know a lot more about than other people. Start following some of these companies on apps like Seeking Alpha or even Yahoo Finance. Check out what other people are saying about those companies and whether their opinions differ or meet yours. It just helps you build up a bit of a clear picture of where the company's going, what the general consensus is around the company and its future, and then it helps you make a better investment decision whether you decide to invest in that company or not. An example of when I've used this strategy is I did a degree in automotive technology and started working in that industry, and the first investment that I actually made was in Fiat Chrysler, which is an automotive manufacturer. It wasn't the main reason that I invested in it because I knew more about the industry, but it just helped me feel a bit more confident that I knew how the business made money, what its expenses were, and where they were potentially going in the future. Number 2 on this list is to enjoy being a beginner or a retail investor. It sounds a bit mad, but the retail investor does actually have quite a few advantages over the larger hedge fund, which people are only really just starting to realise. Aside from like the GameStop, AMC short squeezes which have been going on at the moment, which have been killing hedge funds, and it's just like a way of retail investors coming together on Reddit and attacking the big guys, which is very entertaining and funny to watch. What I really mean by being like an amateur is essentially just getting involved with it because you love it. If you make it your hobby and start looking at it in your own time and start putting money aside every month to invest, just like you would if your hobby was mountain biking or snowboarding, you'd put money aside to buy a new board or a new bike. Do the same for investing. Knowledge compounds just like your money does, and the more you learn about it, the more you start to understand the market, how companies trade, how earnings are calculated, how companies are valued in different sectors, understanding business in general, balance sheets, financial statements, and general economics. You'll be surprised just how much all of this knowledge actually helps you out in like your general career, whether you're going for a new promotion, climbing the corporate ladder, or going self-employed or starting your own business. The more you sort of understand and learn about all of this company earnings, knowledge, statements, cash flow, all that sort of stuff, it really does actually help you out a lot and helps you understand, even when you're going for a job, what companies are going to be around in 10 years time and what companies are maybe on the brink of some financial trouble. It's helped me out a lot and helped me understand a lot more about the whole world and how the whole financial system works. So make it your hobby, get involved. And if you find stocks that you like, use sites like Guru Focus, where you can go on there, search some of your favorite investors' names and look at what their holdings are, what they're buying, what they're selling, and then start looking into the stocks that they've bought and think, why have they bought this stock? And really drill into it and see, would you do the same? Do you agree with their thesis? And it just helps you build up all of this sort of knowledge and awareness of what's going on and what people are generally thinking. And it can help you make some really good decisions. Potentially. The third thing on the list is to play the long game. Don't try and time the market. So as easy it is to get drawn into these hype stocks or these meme stocks which are going 300% in a couple of weeks or a couple of months, they can just as easily plummet 50% in a couple of days. This can wreak absolute havoc with your emotions, and if you've not been investing for very long, it can really make you worried, concerned, and if you've been burnt quickly, fast, it really puts you off. And you've just got to have that long-term vision. If there's one thing I can say out of everything on this, it is to just play that long game. Have a long-term outlook on anything in investing, especially in the stock market. It can be very volatile, as you've seen over the last year, where we had the coronavirus pandemic drop, we've had the rise, and now we're making new highs. We might have another drop, we might not, we might go on to rally for the next 5 years. No one really does know. Economists may predict it, big people on Wall Street may predict where they think it's going to go and have some very strong opinions on where it might go, but the reality is no one does know. But what we have seen from history is that over a 20-year period, stocks have always outperformed crashes, and generally the market has risen over time, whether there's been crashes like the 1929 crash, the 1987 crash, the tech bubble in the 2001 and the 2008 crash, and even the recent coronavirus crash. As you can see from the chart, overall, long term, it always goes up. And what people make the biggest mistake of is buying high and selling low, which sounds ridiculous, but you'll be surprised. This is the main difference between investing and trading. This video is about investing. Trading is where you're trying to predict something in a matter of months or maybe a year. Rather than investing, you really just need to think long term. The more patient you are, the better you're going to do, to be fair. Number 4 on this list is to dollar cost average. Dollar cost averaging is essentially when you purchase a smaller or an equal amount into a fund or an investment at frequent periods over time. The best way to explain this is with an example. I've even spoke about this in my portfolio update video where I talked about how I was going to dollar cost average into Bitcoin. What that meant is that every 3 to 4 weeks I would buy another £200 worth of Bitcoin over a period of time. All that means with dollar cost averaging is that it eliminates some of the volatility that you'd be susceptible to if you were to invest your full amount that you wanted to invest straight away, as this may drop 20% overnight. If you buy in frequent amounts over time, which is definitely what I would recommend doing. For example, you want to start dollar cost averaging £100 into a fund, let's call it a fund, over the next 20 years. So you want to invest £100 every month into a fund over the next 20 years. The stock price of that fund could be £100. So the first month you buy, it's £100 you invest in, and every time you invest 100, when the stock is at 100, you buy one share. For whatever reason, the stock drops to £50, but you're still investing £100, every month, you're then buying 2 shares a month instead of 1 share a month. The price of that stock then rises back up to £100, but because of the few months when it was trading at £50, you've managed to accumulate more shares for less of the cost. I hope that makes sense. This is especially important when you see big crashes happening. For example, when the pandemic happened, say for example you were buying shares in the S&P 500 as a whole. If you carried on investing £100 each month, when the market dropped off significantly, you would be getting more for your money. And then as it rises again, all of those times where you bought more for your money, all of that's going to rise in value and you'll actually do better off over the long term. So it doesn't matter whether you're buying the stock when it's at its highest or its lowest, you're buying an average every single month because your long-term view is that that is going up. This practice is done very well over time. It's very widely known. It's one of the most simple strategies to use, and it's definitely something that you should probably consider if you're a beginner and you're just getting into it. So number 5 on the list is to essentially just buy the market. So Warren Buffett, who's widely regarded as the best investor of all time after Jeff Bezos, his wife. No, I'm joking. Widely regarded as one of the best investors of all time. He famously has instructed that in his will, 90% of all of the money that his family inherits when he dies is to be invested in a low-cost S&P 500 index fund, which is what we're talking about now. To give you some perspective on this, over the last 90 years, the S&P 500 has averaged 9.8% return. So if you just invest into this passively, dollar cost averaging, for example, for 30 years, starting with £1,000, and you invest £250 each month, which is a fairly reasonable amount to suggest for the average person in the UK, and you accounting for inflation at 2%, over 30 years, you're going to be left with a huge amount of money. It's something that's going to take not a lot of your time. You can set this up completely passively through direct debits, and you basically just, this is going on in the background while you're out enjoying and living your life. You're building that portfolio, building that wealth for when you retire, when you want to purchase a property, or whether you want to just do whatever you want with it. So what these index funds actually are, there's 2 big ones, VU and SPY. They're both index tracker funds for the S&P 500. There's also ones for the FTSE 100, the global index, and lots of other things, which I'll leave some information to in the video description. When you invest in any one of these funds, what you're actually doing is purchasing a small share of the 500 companies that are in the S&P 500 index. So you're completely diversified across the whole market, and you're basically just tracking whatever the stock market does. These funds will buy and sell to keep that tracked over the long term. This is pretty favorable when compared to sort of hedge funds or mutual funds, because you're not paying someone directly to make any decisions or manage your money. What you're doing is paying an algorithm or a robot, however it works, to just follow that fund. So the expense ratios are very low, and you can pretty much match exactly what the market is doing year on year. So some of my sort of general tips that I sort of do when I'm looking at any sort of investment is I try and make sure that I completely understand how that company makes money, why it's going to continue to make money in the future, and how it's going to sort of fend off competitors and continue to be a market leader. Basically, what has that company got that you're investing in that is going to stop it being attacked from other people that would take away profits and earnings from that company? If you can find companies like that in your industry that you know about, or companies that you know are going to do really well over the long term and have got a significant competitive advantage, then you're going to do pretty well. Really think about what you're trying to get from doing any of these investments, where you want your portfolio to be. Have you got a life goal that you want to retire at 40, or you want to purchase an income property at 35, or you just want to build up a lot of wealth for retirement? Use the compound interest calculator, which I'll leave a link to in the description. Put in what you can actually save each month, or what you're prepared to save and invest each month, and just track it over time and see what the change in interest rate might be and how you might be able to perform and meet some of these goals that you might have in your head. And it really should cement in some views of what you can actually achieve if you really dig in and just basically enjoy getting involved with investing, because it is pretty interesting once you get into it. I hope that has been useful. As I said previously, I'm going to be doing a video about how to use Trading 212, which is the app that I'm using at the moment to invest and purchase individual companies. I've also got an ISA with my local retail bank, but Trading 212 is rare because it's commission free. It's easier to sort of buy in and buy out of shares a lot quicker. I'm going to be posting a video on how to use that very soon. I'll leave some information about it in the video description if you want to check it out ahead of time. If you've got any questions about anything that I've discussed so far, please jump in the comments and let me know. I'm very active in the comments. As I've said, I'm not an expert by any means. I'm just interested in this subject. And if we can talk about it, help each other out, provide different investment ideas, strategies and recommendations, then we'll all do well and it'll be decent. So please hit subscribe, please hit like if you haven't done already, and I appreciate you watching the video, and thanks again. I'll be back again soon.